If you are a day trader and you are not doing top-down analysis, you are leaving money on the table. Let me explain. Top-down analysis is great for many reasons. It gives you context on the overall market, which builds your confidence and increases the accuracy of the trades that you take. It makes trading less stressful as a whole, and it's going to open doors to potentially massive trades that you wouldn't have gotten if you hadn't done top-down analysis. Now, I know as a day trader, you might think I don't need to do it because I'm getting in and out of the market quickly, but trust me on this, if you bring top-down analysis in, your day trading results are going to get better. Miles better. So in this video, I'm going to be putting together what I've found to be the best approach to top-down analysis for day traders. And this is from years of experience and helping traders to make millions of dollars. So it's going to be broken down into two sections. We are going to have weekend work and we are going to have day-to-day work. The weekend work should take place probably on a Saturday or a Sunday. It's not going to take a lot of time, but this is just stuff that you definitely don't need to do every day. It's time consuming and boring if you do that. You can actually just do this once and then trade day to day with the structure that I give you. So on the weekend work, we are looking to analyze the high time frames. With this, we're going to develop narratives and we're going to build clarity around what the market is doing from a larger picture perspective. With all of this in mind, we can then move on to doing our day-to-day work, which is what we'll do for 10 to 15 minutes at the start of each trading day to actually execute setups inside of the big picture narratives that we've built in our weekend work. So day to day, then we only need to analyze low time frames. We need to build trading ranges to work within, and we need to make our actual executions, take the trades that we found through our analysis. Now the weekend work is going to take place on the weekly and the daily timeframes. The day-to-day work is going to take place on the hourly, the 30-minute, the 15-minute, and the 5. Now I'm not going to include the 1. You can trade the 1-minute time frame if you really want to. But I think if you're watching this video, you're probably not profitable with your day trading yet. And the 1 minute is probably the hardest time frame to become profitable with. So I'm going to suggest you just stick to the easier ones. Go as low as the 5, but I would cut out the 1 for now. If you're not profitable yet, there may be a reason why. And I know 1 minute's exciting, but it might not be the most profitable for you right now. So what we're going to do is jump over to the chart right now. I'm going to run you through this top-down process from the weekly. Yes, I know that sounds crazy for day trading, but just trust me on this, all the way through to executing and managing a position. And I'll show you why this is just so good. Let's go. All right, so step number 1, that kind of weekend work. We want to begin on the weekly time frame. And our goal on the weekly, because we're day trading, is just to look at previous weekly candles and build ranges and narratives surrounding where the market could potentially go. Now, if we were doing swing trading, we may want to zoom out on the weekly a bit and kind of work out some of the areas of supply and demand that we could be looking to buy or sell from. But there is only really 2 things we want to consider from a day trading perspective. The first is previous weekly candles. So we're looking at this week's price action right now. This is where we're trading. If we look at the previous weekly candle, which closed, what we want to do here is try and get an idea of the momentum and who's in control between the buyers and the sellers in the market. Now, this candle shows a massive bullish push. Okay, we're looking at this blue candle here. If we consider the price action that this candle has printed and how this relates to the battle between buyers and sellers, we can see that this has wiped out 1, 2, 3, 4, 5, 6, 7 previous candles. So within just 1 week or 5 days of trading, we've erased 7 previous weeks of downward price action. This shows that buyers are very much in control. And by looking at this weekly candle, we understand that, well, the following week, if we still see this significant amount of buying pressure, is likely to be bullish. So the immediate thing we get from the weekly chart is just seeing how strong the buyers or sellers are. Okay, in this instance, the buyers are very strong. So we can consider going into the new week with a bullish bias or an idea to go long or buy. The second thing we want to look at is potential targets. The way we do this is by looking at efficiency in the market. So just to show you what that is, an efficient market is a market like the diagram that I'm drawing up, where every time we create a supply zone in price, we move away and then we pull back and we retest that supply zone, okay? So this is what an efficient range looks like. Now, an inefficiency is kind of like this push down, where we created a supply zone, which would be just here at the top, and then the market pushed away, but it didn't pull back yet. So the area that we create between where price is now and where the next supply zone is, that is the inefficiency. Now this works the other way as well with buys, okay? Any open price range created from an area of supply or demand creates an inefficiency. These inefficiencies are likely to be traded through, and they're also likely to create reactions when they've been filled. So if we have an inefficient price range, that can potentially act as number one, a magnet for price, and number two, an area for the market to react from. So for example, we have a small inefficiency down into here. If the market was to pull back to here, we would expect to see the market then push away. So if we had an inefficiency up here at the top, meaning if we had an open price range, say there was a supply zone and then a sell-off from there, we could consider that if the market was to reach the area of supply there, it would then reverse. So we would expect to see something like this. However, in this instance, we don't have inefficiency, okay? We just have this huge wick, which is an efficient price range. There is none of that imbalance that we've discussed. Now, when we have an efficient price range, so efficiency like this, and a target, which is just a massive wick, we have no real reason underneath this level for the market to reverse, right? So we could anticipate that the market will continue all the way up to this point and trade over this point, because at this point there is no reason for the market to reverse under this level, okay? There we've built our bias. We have a massive push of strength from buyers, which gives us a bullish idea. We could expect that if the buyers continue, we are going to see the market going up, and we have no inefficiency. We have an efficient price range with the high topped out here, which will act as a very clear target for the market, which we could use for high time frame biases. Now, we don't always need to hold our trades up towards these massive targets, right? Because I know as day traders, you probably only want to be holding trades for a couple of hours, not a couple of weeks. But it does open doors to potentially maximizing profits on trades, which is something we're going to cover very soon. All right, so now we would go to the daily time frame. And once again, this is weekend work. All we're looking to do on the daily is once again, just realign, make sure there is no inefficiencies that we should be aware of. And then we want to just take a look at the existing candle moves. Here we have 1, 2, 3, 4, 5, 6, 7, 8 consecutive bullish candles. This shows that buyers are very much still in control. We have massive strength from buyers here, and that reason leads us to believe that we should just look for opportunities to continue trading bullish, okay? We just want to move with momentum. If momentum is super strong, then we can use our day trades and our lower time frames to execute positions in line with the bigger picture narrative, which is, in this instance, exceptionally bullish. So nothing has really changed too much here by looking at the daily. The only other thing we can see here is that we've broken structure as well, once again just adding to the bullish narrative. And what we've done here, if we carried this workout on, for example, Sunday, we would now know for this week, we are trading in a very bullish market. And our overall idea should be, if a day trade provides opportunity to buy, we should go with that. But if a day trade provides opportunity to sell, maybe we should think about this before we get into it, because we have a hyper bullish market with a very clear bullish target as well. So this big picture narrative gives us the idea to buy, not to sell, okay? Now we can move into the day-to-day work, which is what you'll be doing on those lower time frames. So now we've jumped down to the 1 hour time frame. We still have our high time frame narrative target up here. And now we can start to look at the more close trading range. Now for day trades, we don't need to worry about these massive imbalances being filled before we start looking for buying opportunities, okay? For a swing trading perspective, a trade would look something like this. If the market was to get into here, we would look to buy. But there is no guarantee, unless structure shifts, that we are going to be getting all the way down there. And because we are only looking for smaller movements, so we are simply looking to trade within, realistically, 1 or 2 of these hourly candles, we don't need to go and wait for those massive moves. We can actually trade more immediately inside of the existing price action. So what we want to do on the 1 hour time frame is build what I call a daily trading range. This is simply a price region that you are going to be trading in for that day. The most simple way to build your daily trading range is to consider the existing swing point, the existing leg of price action. So the most recent leg of price action, we bottomed out here and we traded up all the way to here. This is around 4 hours of price action, right? 1, 2, 3, 4. And this is going to provide us with our daily trading range because we are bullish on the market overall. We know we want to buy. And now ideally, our opportunity would be to buy within here, targeting here. This would be the general idea we'd look for. Now, sometimes daily trading ranges could be extended a bit further. Let's say we had an imbalanced demand zone somewhere around here. Well, then we could draw our daily trading range a bit lower because it would then, in that instance, make sense for the market to trade lower and then still continue trading higher. But in this example that we're looking at here, we have no imbalances, right? You can see, as we've said, in line with that theory of efficient markets, every time we create demand, we push away, we pull back, and we retest. And then we push away and we pull back and we retest. Every one of these candles is retested with a wick, and there are no open candle bodies all the way down towards that point we discussed for potential swing trades. So because this range is efficient, this generally means that all of the orders have been filled and there is no reason for us to go under this level. We do have, at this point, some small inefficiency, or at least we did just one moment ago, which would have been from around this candle here up towards this top. This pullback has started to fill the inefficiency, but this means that basically the only point we need to consider for our trades from an hourly perspective would be this demand, therefore creating our daily trading range between this low, this high, and our general consensus in line with the high time frame narrative will be buying there and targeting there, okay? So now we can go a little bit lower. Now the 30-minute time frame really doesn't tell us anything more in this example. It's a good one to check to see if we can find any opportunities from it. But for this one specifically, we're gonna just go straight down to the 15-minute time frame. So on the 15-minute here, we have this area of demand. This could be a potential good place for us to buy from if the market came into it. Now there would be two ways to approach a trade here. We could, number one, just use a buy limit directly into the market from this level. We would probably want to keep the swing low covered in this instance though. And then if we were to set our target at the high, we're looking at only around a 2.5% return, which is okay, but we ideally would want to get more. I like to go for minimum 3R, meaning I can win 1 in 3 trades essentially and still be profitable there, okay? So I wanna make sure that I can get this above 3%. Which means I'm going to do one of the biggest things about day trading and refine a little bit to see if we can find the best possible entry for this position. So going down to the 5-minute, we can see this demand zone could be refined towards this candle here, but we also see something very interesting here as well. And that is that we've got a demand zone just down here in the low. Now, an interesting thing about this demand zone, we have our top of demand here, and we see there is still a very small inefficiency into this level. So what we could expect to see is, even though the inefficiency is very small, the market can come in and retest that level, and it likely will. If we take a look at the origin of this demand zone, we had a demand zone and then we had a push up here, which has broken some structure. This push up, breaking structure, tells us that the demand zone we're focused on, this one, has created a lot of demand, and we've seen a lot of buying coming into the market from this level. Now, if this is an area that major buying has taken place previously and it hasn't been filled yet, we can essentially see this very simple logic. If this is a discount price that people are happy to buy from in mass, it's probably going to be a discount price that people will be happy to buy from in mass again if the market gets into it, all right? So our trade opportunity now could look like this, a nice refined example where you could buy limit it if you wanted to, and that would be a very high risk reward trade. But what we're gonna do is something a bit more similar to what I would do here, and we're gonna look at a more confirmation focused approach. So now that we're down here on the 5-minute, ideally what we would want to see is the market coming down into this level, retest it, and then start to break structure to the upside. Why do we wait for this? Well, the reason I wait for this is because it creates that high accuracy. If we think back to our high time frame narrative and every step we've taken in this analysis journey so far, we built a bullish bias on the very high time frames. We've then built this bullish bias on this lower time frame. Now we want this very lowest time frame, the execution time frame, to also align with our bullish bias. Okay, so we want to make sure that the 5-minute is bullish in line with every other time frame that is also very bullish. So we wait for the market to come into this level. As we can see, it has done just that. And now the real structural point for this piece of price action would be this high here. So if the market was to close above this level, we could buy, we could have our stops in the range at a safe level, and then we can take this market all the way up to the high, okay? So let's jump this forward a little bit. Here we see the market's pushed up and created a closure above that previous wick. So we're just gonna line that up. There's our closure. Now what we could realistically do would be use the demand zone beneath, just here, to enter a trade, and we can put our stop likely under the swing low with a better risk reward at this point. So we can buy here We can have our stops under the low, our targets up into the high, and now we're looking at a 4.17% potential trade, right? So this alone, this setup, you could have potentially found something like this without the high time frame analysis. However, the risk you run by doing that is because you don't have much context. You may have seen that the market reversed sharply from here. So your immediate instinct may be to start selling. You may say, okay, with this push down, we've broken multiple points of structure in this move. So if we pull back up, we will look to sell the market lower. The problem with viewing things from such a low time frame perspective there is that when you incorporate the high time frame narrative that we've looked at, it becomes completely obvious that this is the wrong thing to do. And it's the fact that we've done that high time frame analysis, that we have the clarity and understanding around what the market is actually doing. That's what's going to give us the confidence to take this trade, and that's what's allowed us to actually find this great position. So now we're going to look at actually executing this position. And the way that we're going to do it is we are going to open it in two sections. The reason we're going to do this is because I want to show you how you can profit maximize using top-down analysis. So my usual risk for a position is going to be 1%. What we're going to do is open two trades at 0.5% and leave one of them running. So we are going to use buy limit orders to get into these trades, okay? That means if the market comes down to that level, we will be tagged into the position. We're going to open the second one as well, which is going to be another 0.5% risk. So now we're risking 1%. But what we're going to do is draw one of the take profit levels all the way up to that high time frame narrative target, which is all the way up here. This is a massive risk reward. So realistically, we've got a day trade with a 4% potential return, but we can, if we want to, optionally swing trade this into something that could get a massive return. Now, I know if you are a day trader, you're probably not going to hold trades for that long. But even if it got a little bit further, you're locking in a bigger profit. And because we have that understanding that the market is likely to go higher, why not hold some to maximize the profits that we can make on this move? So now with this said and done, let's just allow this trade to play out and you will see the process coming together. We have the high time frame, which built our initial bias and narrative for this market. And now we're moving into this lower time frame. And as you can see, we've reacted from demand and we've started to push up, and the market very quickly trades through towards that first target, okay? Now you're going to see the beauty as well. The first trade is now closed and we have realized a profit of 2%, okay? Because we had a 4% trade and we've closed half. We have an unrealized profit of another around 2%. But what we can actually do with this one is hold it and move it even further into profit, which actually comes from the fact that we did that high time frame analysis and understood that the market is likely to go higher. And now I've moved over to trading view because that trade cut me off, the backtest ended, but we can see in real time now at the time of recording this, that if we'd held this trade past the initial target of around 4%, which would have been the first overall target, if we'd have held a portion of that position out, it would now in real time be trading at 11.5 R, which at 0.5% risk is going to be around 6%, okay? So you can see that just by having that high time frame narrative, which was to target the 1.71800 level, we actually managed to massively maximize the profits taken on this trade. We took around 2% profit there, and we'd be running a further 6% profit here. So we've turned a 4% trade into an 8% trade overall, just by having that high time frame narrative. And as I said, you may not want to hold trades all the way. Maybe you still want to get out within the day, but even if you did, you could have got out up here or even up here and added 1 or 2% to the profits that you'd have made on the move. To quickly recap the process, we are going to begin on the weekly and daily timeframes. And here, all we're trying to do is build a narrative. We're going to find high time frame directions, targets, and momentum using the weekly and the daily. When we've done that, we're going to go day by day to the hourly and 30-minute, where we build our trading ranges for the day. So the upper boundary and lower boundary of where our trades are likely to take place this day. Then we build our narratives inside of there to find our actual entry zones and the best place for stop losses. We then go to the 15 and 5-minute to kind of refine all of that, find our target, our entry, our stop positioning, and actually execute the positions that we've crafted through this top-down flow. And the weekly daily work should be done on the weekend, whereas the hourly down to the 5 minutes should be done day by day. So this way you can get all of the benefit of the high time frame work without having to make it super time consuming and spending every day doing weekly analysis for pretty much no reason. Now, the next thing you need to do is go over to the top link in the description and join 7 steps to profitable trades. In here, I show you how to build your first very own trading system. So we're going to go through the process of building a strategy and a trading plan that you can use to consistently take money from the markets. And what you can do is weave everything we've covered today into a personalized system that works for you. So it's 100% free. You can sign up using the top link in the description. I highly recommend it. Thousands of people have been through it and I've heard nothing but good things. But if you don't want to do that, check out the video that's on the screen somewhere here now. That one's going to be beneficial for you as well. So thanks for watching and I'll see you in that video or in the free course.